The thing about what's happening in industrial that few people are talking about is the need for power. And so it used to be a case when you bought an industrial building, you show up, a tenant would show up and say, okay, where are the lights? What's the rent? What's the drayage, which is the cost of getting goods to and from the port? And then how big is the labor pool? Now it's like, how many amps do you have? And it's an instant disqualifier. And it's going to become more and more important. In LA, which includes the Inland Empire, Orange County, LA, Las Vegas, and Phoenix, there's only 20%.
All right. Good afternoon, everyone. And thank you, Marty, for another great first day. And don't forget the drawing for the bottles of wine. So welcome to the From Stress to Selective Offense Real Estate Investing in 2026. My name is Jim Bowles. I have over 30 years of experience in asset management with a primary focus on new business development and relationship management. I spent over 20 years at Common Fund, a nonprofit asset management firm, over 3 years at Prana Investments, a company focused on rent-stabilized multifamily properties. Currently, I'm working with the Green Impact Exchange, GICS, and last April, GICS received one of only 18 exchange licenses ever granted in the United States. The license provides a regulatory mode that's helped exchanges to be among the most lucrative companies in the financial sector. And in addition to outstanding economics, the recent SEC ruling clarifying that any tokenized security must be traded on a regulated exchange, and that creates outstanding upside potential. And I'd be happy to talk to anybody after this. So we meet at a point in the cycle where a single headline no longer drives a real estate market. In many sectors, values have begun to stabilize. Capital is returning to the market and transaction activity is improving. At the same time, distress, refinancing pressures, and a widening gap between strong assets and weak ones continue to shape the opportunity set. For family offices and long-term investors, this market rewards patience, selectivity, and structure. Some sectors are showing real momentum. Others are dealing with capital stack stress. And some of the best opportunities may come from complexity rather than consensus. So our panel today combines the lenses of restructuring specialist, a family office CIO, an active value-added investor developer, and industrial owner operator. And together they'll unpack the real opportunities, where the real opportunities lie, where the challenges remain, and what that means for allocating capital in 2026 and beyond. So give me a minute to introduce our panelists. First, Harold Bordwin. Harold is principal and co-president of Keene Summit Capital Partners, a real estate brokerage workout and merchant banking firm focused on complex situations, including Chapter 11, receiverships, restructurings, and litigation. Keene is now in its 44th year. It sells all property types across North America, restructures leases and real estate debt, provides fiduciary services, and arranges or invests in DIP loans, bridge loans, rescue capital, and discounted debt purchases. Paul Sygrove. Paul is the Chief Investment Officer of Real Estate Family Office, focused on investment and development of commercial properties. Paul also acts as an advisor to families with real estate assets. He has deployed more than $4 billion across commercial, office, multifamily, and mixed-use sectors. His recent work centers on repositioning assets for superior risk-adjusted returns and driving innovation in high-value real estate markets. We have Doug O'Donnell. Doug is a founder and chief executive officer of the O'Donnell Group. You just heard him. It's a 3-generation family-owned industrial real estate platform that's developed or acquired more than 24 million square feet of warehouse and logistic properties nationwide. He leads the firm in strategy, capital formation, acquisition, and asset management with a focus on last-mile infill, industrial assets in the 15 to 35 million range across key U.S. markets. And finally, Nick Chen. Nick is the founder and managing partner of L3 Capital Group, where he directs investment strategy and leads the firm's acquisitions, development, repositioning efforts. L3 specializes in value-added acquisition and development in New York City. They turn undermanaged urban infill and mixed-use properties into higher-performing assets through adaptive reuse, new construction, and hands-on asset management. Nick's investment activity focuses on unlocking value through repositioning, design, capitalization, and execution. So could each of you spend a couple of minutes on your background and firm that you're working on today? You want to start, Howard?
Sure. Hello. So nice to meet you, and thank you for sticking around until the end of the day. My company is King Summit Capital Partners. In the context of a family office meeting, the company was started by my father in 1982, and my brother is my partner. So there's a family thing going on here. We specialize in troubled situations. I began my career as an attorney, left the practice of law in 1988, and have been in this business since then, 38 years. We have gone through a couple of different corporate transactions. We sold our business for a brief period of time to KPMG Corporate Finance. We were there. I was a principal at KPMG. And since that time, I have been running this business with my brother. Our primary services are real estate disposition. We sell real estate. We're brokers and auctioneers. We're property type agnostic. We work across the country. We do real estate restructuring, which is debt restructuring, as well as lease restructuring for tenants who need to negotiate with their landlords. Those are our two main businesses. And on top of that, I'm a fiduciary. I'm a court-appointed receiver. I've been an independent director in a distressed hospitality bankruptcy. I'm an asset manager right now for a group of banks that made the mistake of foreclosing on a mixed-use office, tech, medical park, and that's the scope of what we do.
Great, thank you.
I'm Paul Sygrove. I work with a single-family office with iconic properties both here in New York, from Seattle down to California, LA. I'm most recently going on to working on a fractional basis, which gives me the opportunity to work with multifamily officers and officers in real estate, advising them on their real estate portfolio or their non-real estate portfolio.
Hi, my name is Douglas O'Donnell.
Green light.
That's better. We're a fully integrated industrial real estate company based in Newport Beach, California, the office in Miami, fully integrated with property management, asset management, and leasing. We're fortunate enough where we sold 88% of our active portfolio in the COVID and post-COVID area, where the interest rates were extremely low, cap rates were extremely low, and rental rates were absurdly high. And now we're looking for the first time, we're raising a fund for outside investors, where we've always worked with institutions and pension funds and advisors in the past. We're going direct to the investors. And so we're here looking to raise a $100 million discretionary fund to take advantage of infill industrial properties nationwide, as I discussed previously.
Hi, I'm Nick Chen. I'm a founder and partner of 3 real estate companies here in New York, including construction, development, and a sales brokerage company. On the acquisition development front, we acquire anything hairy and complex. That's actually our specialty. On the sales side, we actually advise a lot of families and family offices. Our transactions range from a few $1 million to over $100 million here in New York and Long Island.
Great. So where are we in the cycle? So Harold, from what you're seeing in restructurings, are we still cleaning up the last cycle, or are we finally turning the corner?
Well, I like that question because the answer is yes. I'm of the perspective that where you sit, where you stand on a position, it depends upon where you sit. And I sit on the distressed side of the world, so I see that. But I'll say, on the positive side of the world, there are lots of transactions taking place. I have recent statistics that came out this week in North America, commercial real estate year-to-date returns, year-to-date, up 16.1%, which is pretty amazing. Green Street put out another statistic, commercial real estate over the past trailing 12 months, up 4%. Not as good as 16, but still a positive. On the other side, where I sit, I think there's still a lot of hangover from the rise of interest rates and the decrease in value in real estate. So CMBS distress right now is at the highest level since 2022. In 2022, the distress rate was 5%. It's more than double now, approaching 12%. Office properties are still 34% off their peak value. Multifamily properties are still 19% off their peak. So what we see is for property owners that have debt that they took out 5 years ago or more, where the interest rate's 3.5% plus or minus, and it's fixed and it's maturing now, and your debt at the time you took out the loan was 75% or more loan to value. Maybe you've got a second lien, maybe you've got mezz debt. As that debt's maturing today, you're underwater. The likelihood that you can refinance is slim. Your ability to sell is going to be challenged. It's probably going to be a short sale situation. The other place we're still seeing challenges is with construction projects. There are across property types so many projects that, because of COVID delays plus inflation in terms of labor and in terms of materials, that they've defaulted on their loans and breached covenants and are in deep trouble. And we've come across a lot of that. On the lease side, we represent a lot of casual dining restaurant chains and QSRs. QSRs are quick service franchises, quick service restaurants. And those are suffering from similar issues. Employment costs have risen rapidly in the past 5-6 years, as has inflation. So if you go to a bar and buy a hamburger and it's now $22, that's been your decision. But you can't go to Wendy's. Wendy's and Burger King and McDonald's can't sell a hamburger for $22. So that's kind of what's going on there. The other place in lease restructuring that we're very busy is in healthcare roll-ups. PE shops have been active in the healthcare space, rolling up doctors' offices, rolling up urgent care centers. You can kind of go through all of the patient-facing businesses. And those instances, they paid little attention to the lease obligations, and those are coming back to bite them. So a lot of work in that sector for us.
Great. Thank you. Paul, when you talk to families, how do you describe this moment? Time to lean in, stay patient, or both?
All of the above. The thing is that the time where we're pretending there's nothing wrong is finally coming to a head. We're still seeing a lot of distress. Primarily, the banks have now said, let's pretend there's nothing wrong. And years have gone by now, and now deciding that, listen, this is the time now to really attack this particular asset. The majority of my work to date is in gateway cities. So the assets are generally of large volume as far as dollars are concerned. And so it's a big restructuring for any bank. Generally speaking, the bank's going to take a hit. So we just don't want to have a flood of loans out there to hurt, one, the market, and two, to the bank institutions. So the thing is, when families come to me and say, oh, we hear about this distress. What is the cost of that distress? Everyone's looking for a deal. We're all looking for deals, but the deals are very far and few between.
Yeah. Great. So Doug, from an owner-operator standpoint, especially in industrial, does this market feel healthier on the ground than it did a year ago, or just more active? Sorry.
It's a very, very healthy market, but I always say that real estate's not a commodity. It's really market by market, and then inside the market, it's size range by size range for industrial. And I think for going to the debt side of things, before the Iran war, fourth quarter of last year, there's 88% chance of rent or interest rate reductions. Now it's a coin flip or a 35% chance of an increase. And so all the banks were so excited because rents in industrial were going up and have been going up. And the anticipation was there was going to be a Fed cut, Powell was going out, and rates were going to come down. And that just got slammed. And so now they can't kick the can down the road. They have to deal with it. And so that's what I was talking about previously, is that there's going to be forced sales and or remargins. And a lot of the equity is getting wiped out, and people are going to have to pay down their debts. In terms of industrial, is 110 million square feet in the first quarter, which if that's annualized, is going to be a record year for industrial. Industrial is relatively healthy, with 7% vacancy factor nationwide. Granted, that's skewed because Austin's the highest at 23%. Nobody would really think that because Texas is such a great state. And then the lowest is like Richmond, Virginia, and Columbus, Ohio have the lowest vacancy in the United States as it pertains to industrial. So the fundamentals are very, very strong. But what's happened is the industrial developers who developed at the very low rates and the very, very low interest rates and very high rental rates, the debt's coming due, and that's going to have to be dealt with this year and next year.
Nick, from the deal flow you're seeing, does this feel like a real reopening of the market, or still a cautious grind?
I think it's a selective reopening. Everything, as my panel has been saying, is largely correct. Entirely correct. There's a low maturity wall that's actually confronting us that I think we have echoed here. More than $1 trillion of real estate debt will be due in the next couple of years. And that puts a lot of pressure. But on the flip coin, though, guys like myself and the shop that I run, we're very selective in making the certain type of acquisitions that make sense. We're seeing a price discovery because of the pricing of the pressure from the bank and the lender who are no longer looking to extend their loans. So because of that, we're actually seeing quite tremendous amount of opportunities to deploy capital with our families and other family offices into certain deals that makes a lot of sense. Because of that, the fundamentals, as Doug was saying, is actually the real estate fundamentals are actually pretty strong. It's really the capital structure distress that exists in the market that's making it very difficult for a lot of the legacy owners to get out of their deal. But then for the capital that's parked on the side that looking to redeploy, I think we're probably in the second inning or third inning of the new cycle to get back into the market.
Doug, in today's market, where are you seeing the strongest conviction in industrial and logistics, and what still gives you pause?
The Sun Belt and the Rust Belt, believe it or not, have been the strongest in terms of absorption and in terms of the future. If you read Green Street reports and CBRE, Cushman & Wakefield, et cetera, they echo that fact. And it's a lot of reshoring, especially in, say, Phoenix. You're also getting that in the Rust Belt. In the Rust Belt, what happened is during the COVID era, when rental rates were ridiculously high and interest rates were low, they had a constraint on new development. And so as a result, there wasn't a lot of new supply that came online. Whereas the Sun Belt was kind of like Wild West, building, but they had the population growth to offset it. And so it's a very, very interesting times. And it goes back to what I was saying before. Real estate's not a commodity. You have to treat every market differently. Everyone has different vacancy rate. And then inside that market, you have to know which buildings lease and which don't, and which size range.
Great. So Nick, in your pipeline, what kind of deals are you diligencing in 2026? What are you investing in, and what are easy passes?
Easy passes are any type of real estate that has the expectation of the last peak cycle. We don't buy anything with that kind of basis. So all the acquisitions that we make have a basis reset already. We're probably around 30% in valuation, lower than the peak in 2022. So any of the deals that we go into could range from office, retail, multifamily. We do multifamily construction and development. So we would go into anything that has a basis reset, and that where we have the seller and the buyer, in our case, have meeting of the minds.
Thank you. Sure.
Yeah, I like what you're talking about when you say basis reset, because that's a very pretty sounding phrase. But this is what basis reset means. You bought the property for $50 million and you were paying interest at 3%. And when you bought it at a 4 cap. And now it trades at an 8 cap. And I'm not doing the math off the top of my head, but the property is now worth $30 million. And your debt is $40 million. And you're like, what the hell is going on? And what am I going to do? So this price discovery comes about after the owner has stalled as long as he can, because it doesn't want to take a loss. And the bank has stalled as long as it can, because it doesn't want to take a loss. And now all of a sudden, maybe the regulators are pushing, maybe it's a private lender, and the private lender is just sick and tired of not moving on, collecting what it can. So there's a lot of pain involved in this price discovery when you're being able to buy property at 30% off its peak.
Paul, let's go to you. What are you seeing or investing fresh dollars into projects right now, and what's the simple thesis behind it?
I think a lot of investors are looking at, obviously, distress. It's a great market. You've got white knight capital. That's a big thing right now, where owners know they're underwater. They may have lost their equity, but they can still retain the property. There's a lot of investors out there who are not fully integrated real estate companies. So they've got no equity, or the equity's gone out of that particular building. Let's recapitalize with a new partner and recapitalize the function of the building. I'm seeing that more and more, where people are looking just to be the white knight and to recapitalize and gain control of the building that way.
All right. Thank you. And Harold, in any deals you're selling or restructuring, where's the smartest capital showing up most aggressive?
Yeah, the answer to that question is I don't know where the smartest. I know where the smartest capital is not going.
Okay,
I'm not sure where it is going, and maybe you guys have addressed that, right? I don't think that the smartest capital is still avoiding office. The office market is very much a tale of two cities, New York City, and that is regional. Yes, and everything about real estate is not just regional, but it's down to the street. It's very local. So in New York, AAA super properties are just commanding unbelievable rents. I saw today that in the 9 West building, they're about to sign a lease at $400 per square foot, which is just...
Sotheby's building.
Which one?
The Sotheby's building.
Yeah.
Yep.
It is just an astronomical number. I don't know if you have context for that, but let's say pre-COVID, office prices on average in New York City were probably $60 a square foot, with an A office space going for $85 a square foot. Maybe $100 a foot, maybe $125 a foot, $400 a foot in the course of, right? So there are smart money going into great office. There is a lot of money looking at senior living / healthcare because of demographics. And, you know, the things that we're involved in selling are truly troubled properties. We have buyers for them, but we're talking about price discovery. People are coming in and buying at quite a discount to where those properties were earlier purchased and where they were appraised.
Thank you. Nick, what kind of distress still offers good risk reward, and what's just the story with no equity left?
Anything that's legacy has no equity left, including like rent stabilized. There's no equity left there. Don't distress. But anything with what we were saying, a basis reset, there's an incredible opportunity. Anything that we buy as a company, when we buy, we make money, right? And then because we come in at a very good basis and we have a good discount to the deal, and then when we're repositioning the asset, we're doing a construction or renovation, we actually do a tremendous amount of repositioning to the asset, so we make money. And then when we sell the asset, before we sell the asset, we actually we manage the heck out of the asset so that we could squeeze as much as possible. So for the way to just be successful in this market, you have to make margin at every step of the way. So really, for any investor to come in this market, they really have to find a really good partner, an operator, to execute so that there could be margins made at every step of the way.
Thank you. Doug, I think you've touched on this a little bit, but in industrial, are you seeing real distress yet, or mostly isolated cases where capital structure, not property performance, is the problem?
We haven't seen distress yet. I haven't seen it. It's bound to come. It has to.
The wall is there.
The wall's it's coming. People have been, as I stated, the odds were that interest rates were going to come down this year. I don't think they're coming down this year. I think it'll probably stay the same. I don't think they're going up either. But it's a swing year, or a midterm election. And so it's just a matter of how long the banks can hold on, because the developers are underwater. If you bought something in the last 5 years and you're refinancing it, you're underwater. You have to remargin your loan.
Is there any region which you feel is going to be a really hit bad?
Inland Empire is getting hammered because they had a major supply of property. They developed a ton with COVID and rents went up 20-30%, and they thought that was going to go on forever. And there's unlimited land, so they kept building forever. It's exactly why we don't do. That's why we do infill, because you can't just build on forever like you can the Inland Empire. Austin, Texas, they overbuilt like crazy. Miami, very, very solid market. South Florida, very, very solid market. No taxes, ton of people coming in. And it's becoming more and more year round. And there's a ton of apartments being built in Brickell, in downtown Miami, and all over. And it's a trickle down effect. So every supplier needs warehouse space. So if the developer is the lead, the trickle down is like a Christmas tree with all the suppliers needing more warehouse space. So South Florida, we're very, very bullish on.
Thanks. And the weakest market in Texas.
You have a question?
Yeah.
The weakest market being in Texas.
No, Austin.
Okay.
Dallas is strong.
Okay.
But there's a ton of land there.
I love Dallas. It's great. But my quick question is that in private equity, there's all these secondary funds and there's all these continuation funds. Is there the equivalent of that in real estate? Because these continuation ones, they go on forever and you don't realize that something is distressed, right? I mean, is there something like that in real estate where it kind of continues out the distress and allows them to survive, or there's no analogous thing in real estate?
No.
It's extending and pretend. It's still happening.
If you can find somebody to give you a loan.
It's still going on today. I mean, for example, 230 Park Elmsey building, top developer of real estate here in town. They're selling that on behalf of the lender. And the lenders selling it at par. They bought it for over $1 billion. Today, you can buy that same asset for $645, $675. So we're just pushing the can down.
Yeah. I always like to think Jared Kushner got bailed out by Trump getting elected, right? Because he bought 666 Fifth Avenue at a huge loss. I think he was in deficit through 2018.
But that was purchased before Trump went into power.
Yes. See, we got bailed out by becoming.
It was, I think, Brookfield. I think it was.
I thought did he buy it from Sam Zell?
No, I think
it wasn't part of Zell's portfolio.
No, 666. Yeah.
Oh, right, Brookfield. Yeah, they bailed them out. Right.
Yes. I don't know how political that was or not political.
That was,
Club deals.
I'll just jump into something Doug was talking about. I mean, you're talking about industrial. Your definition of industrial, I think, is distribution space.
Well, in what context? There's manufacturing and industrial. It's roughly 50-50 between distribution and manufacturing, and R&D is half, and then distribution is half of the market in general. Generally speaking, that's a breakout.
Are you actually buying manufacturing space?
God, it's so tempting. The thing about what's happening in industrial that few people are talking about is the need for power. And so it used to be a case when you bought an industrial building, you show up, a tenant would show up and say, okay, where are the lights? What's the rent? What's the drayage, which is the cost of getting goods to and from the port? And then how big is the labor pool? Now it's like, how many amps do you have? And it's an instant disqualifier. And it's going to become more and more important. In LA, which includes the Inland Empire, Orange County, LA, Las Vegas, and Phoenix, there's only 20% of the buildings have 4,000 amps or more. 4,000 amps are going to be needed for basic manufacturing and distribution in a matter of years. Basic robotics and conveyor belt systems for automation. And so the biggest need that people do not know about is power. And only 20% of the buildings have it. And so what we're doing is we're retrofitting our legacy assets. We break them out: legacies, ones we own forever, and the other ones are active, are the ones that we sell 3 to 5 year holds, et cetera. And we're upgrading the power to have a minimum 4,000 amps so that we're part of that 20% that gets leased. It's going to be a situation where you have the haves and have-nots in 5 years.
Right. So I get to see a lot of the have-nots, and a lot of the industrial property I see is manufacturing space that was built like 100 years ago.
But sorry to interrupt, but
Okay.
a distribution building can become a manufacturing building with power, because all you do is you lower the lights. But a manufacturing building cannot become a distribution building because it doesn't have the loading and it doesn't have the ceiling clearance height. And so the play is to buy distribution buildings, increase the power, and have the option to make it a manufacturing building versus a manufacturing building that only has one use: manufacturing.
Yeah, I've not heard that before, and that makes a lot of sense. The manufacturing stuff that I look at is 100-year-old factories, and somebody has an appraisal that says that this factory is worth $45 million, and I have to tell them we're going to be lucky if we sell it for $5 a square foot, which might work out to $3 million, because
If it has power, it's worth a ton. A lot more than $5 a foot.
well, I mean,
If it has 10,000 amps or more, it is worth a lot, because it's very, very difficult to get. In order to retrofit a building to get from 1,000 amps to 10,000, if it's possible, it's going to take 5 years.
really,
Yeah.
and cost.
A couple million. All right, it depends, but $2 million at minimum. $2 to $5 million. It depends on the size, depends on the location, depends on where you're bringing the power from. There's a lot of variables, but it's not cheap, but it's definitely worth the investment if you believe that in the future people are going to need more power for robotics, for conveyor belts, for pick and clean systems, and for charging self-driving cars, and for charging trucks, electronic trucks like Elon Musk has introduced, semis that are self-driving semis, and they're going to need recharging. And so the power is the biggest issue as it pertains to industrial going forward.
Great. Thank you. Paul, let's go back to you. When you look at stress deals, where do you prefer to sit in the capital stack today, and where are you staying away from?
We can invest in any part of the capital stack, what makes sense. We obviously, as a family office, if you can get preferred piece, that's the most ideal with a look back. But a lot of people, it depends on the family office and what they're looking to do. But there's lots of deals around, and people, particularly as we're going back to the white knight financing, that piece of equity, you can call it what you want to call it debt, call it equity, you want to call it, as a price. And to get the deal done, it could be in any form. So we have to keep our options open at all times.
Anything you're staying away from, or
Not particularly.
not really?
No.
What's out there? Thank you. So kind of back to Marty's question, Harold, are lenders taking their medicine now, or is the market still in extended pretend? Yeah.
It's both. And, there are lots of anecdotal stories. Some lenders are extending, pretending. I've got a project now where I'm the asset manager. 6 community banks foreclosed on a 18 building, 380,000 square foot office park. And among the 6, some of them I think need to sell, and others don't need to sell, and they want to hold out till we get the best dollar. So it's both.
Right. Well, thanks. So if anyone in the audience might want to know more about your offerings and services, can each of you share an overview of how you typically work with clients or partners, and if appropriate, what type of vehicles or opportunities are open or coming soon, and also what's the best way to reach you? Nick, why don't we start with you?
So our business is predominantly here in New York, so we're readily available. We focus here on multifamily, hospitality, a little bit of office, and some retail. The way we do deals, as I was saying earlier, is that we tend to look at only deals that are hairy and complex. That's where we get the best basis. Anything that beyond that, we really don't jump in. We come in as the operator or the developer. And so in this case, we provide the expertise, the manpower. I have a construction crew of more than 40 people, a development team of over 10 people, and we develop anything here in New York City in those asset spaces. At the end of the day, our focus is on really delivering the value to our investors, and that's really our primary goal.
Thanks.
We're based in Newport Beach, California, and Miami. We're industrial operators nationwide. We do value add, and I'm on the Ivy Fawn group chat that Marty set up. I think he's up to 20 different subcategories now, and
We know you have a fun.
and the like. I think I'm in all of them, but I can be reached at I don't know. Ask Marty. He has my contact. Or ask me. I'll give you my email or whatever. I'd love to meet all of you, and thank you for the opportunity to speak.
Thanks,
I help family offices achieve their goals in real estate, and that could be anything.
Okay.
As you probably heard, I work with complex, troubled situations, whether they're in a court supervised situation or headed that way or something like that. So I'm always open and available to brainstorm. I spend a lot of time brainstorming with people, and I've got a very tight-knit team of 10 professionals. We've been together for decades, and always available to talk about real estate. I'm reachable via Marty, and you can just Google me and find my website or look me up on LinkedIn, and be glad to give you a card. Thank you.
Thanks.
Hey, Jim, to add one comment. I'm also on Marty's WhatsApp group. So
WhatsApp.
I think a lot of us are already. So
Okay. Go on the WhatsApp. That's perfect. All right. So I see a bag that looks like bottles, and I see a bunch of cards over here. So I think we're gonna get knocked out of here. Do we have time for a couple of questions from the audience?
Yeah, questions from the audience.
We have any questions from the audience?
I just want to say that I saw Harold Bordwin, it must have been 4 or 5 years ago, you were posting about distress in the age of COVID. And it's amazing stuff. You have such an inside track on distress that every family office should want to get access to. It's just remarkable, the stuff you see. The second thing is that we are seeing so many sweetheart deals on data center build out. There's a fund out of Chicago, and they're they're building out workforce housing for data centers in Indiana, because Indiana's got all these old manufacturing sites and the electricity's already coming in. And I think that Doug had already pointed out earlier that it takes 5 to 10 years to get a requisition of energy coming in. So it actually makes more sense to just use old manufacturing housing for that. But the sweetheart deal is they're building the workforce housing, but the city government, municipalities are all allowing them to build self-storage alongside that, which most cities don't like. They like self-storage less than they like warehouse, right? And the value, they have a 1 year, one contract commitment for the workforce housing. Somebody gets an apartment, they get free self-storage. But once that first renter leaves, then the self-storage becomes, they can rent it out to whoever they want at market rates, right? So it's a little bit of a sweetheart deal. To me, it's a great sort of investment because you got this extra thing on the side that kind of kicks in afterwards. So you see, I think there's a lot of innovation going on in real estate financing from a regulatory point of view. So anyway, any other questions on where the real estate market is? And so you want to make a comment on Florida, since you're the expert on Florida family offices?
I'm not the expert on Florida family offices, but I will say that it's kind of overbuilt now, and the prices in Florida are very speculative.
Miami's gone too vertical.
Absolutely,
there's no
parts of
infrastructure.
Florida. I mean, the real estate is very local around the area, but there are parts of Florida they're not really livable. You can't live with a family and drive around. Palm Beach is an example of that. And the condos by the water are now suffering a lot because of the extra reserves they have to hold. HOA fees going up, insurance are going up
Through the roof, right? HOA fees.
right? And the population has stopped moving to Florida. I mean, it's increased marginally, but the other states, I think the experts know, is getting much more. A lot of the tax refugees from New York rather than
I think
Florida.
the last 2 years it's flattened out.
Flattened out, yeah. But there's always pockets here and there. Boca Raton is doing very well. A lot of development in that areas.
I guess my question, actually I had a question for Doug, which is that with respect to, does public transportation influence the value of distribution centers, infill distribution? Because it seems like you can get more concentration of people in cities that have subways and light rail, etc. Or am I just totally wrong?
You're kind of totally wrong. Sorry. I love you, Marty, but
I'm just trying to understand the equation.
Can I answer a quick question? So if you go a few blocks away from me, there's a big pit right next to the United Nations. It used to be, in the 90s, I worked at Con Edison. So they ripped it up years ago. It's been empty for years. If anybody knows what's going on with that property, I'd be very interested. More broader question, a lot of deals did not happen years ago because of the environmental considerations. Is that something that just went away, or how did you deal with all that? Because there's a lot of brownfield legislation in New York and other areas. I'm just curious is that no longer an issue?
Yeah, a lot of these energy data center plays are brownfield.
Right. So it's just not an issue, or?
It is an issue. So it continues to be an issue. We've now got some red tape. Sorry. It is an issue, and it continues to be an issue. Although now the current administration has got a red tape for affordable housing for environmental to get through quicker than normal. So if you go to the Bronx and out in the boroughs where we're looking at affordable housing, it has been to the top of the list, and the requirements are not as heavy as the ones like in Midtown.
All right. I think we're about to do the drawing. So why don't I ask you guys to do a final statement? Nick, why don't you start?
So I think the panel today has been very, very insightful. My only addition to that is that I think is now a very frothy time to consider re-entering real estate. If you haven't had your family office, I think a lot of family office have backed down from real estate in the last few years because of the volatility and where the COVID or the inflation or interest rate. But I think right now we're probably entering the second or third inning where you might see some nice deals. So now would be a good time to start, choosing the jockey and looking at particular deals that might interest you and asset classes to make this is probably the time to actually start making good deals where you won't be possible when everything's priced in. I would say in a year or two from now.
For industrial, I think it's a great time to be getting it due to the fact that you have reshoring, e-commerce, which is on fire, reshoring coming. You have AI, where it's going to replace the need for cheap labor overseas, and so people are going to assemble and manufacture domestically. And in addition, you have interest rates at very, very high levels compared to 5 and 10 year averages, as well as what they were 5 and 10 years ago. And you had soon to be record gross absorption, 110 million square feet in the first quarter. That continues. It's an annual record. Low vacancy rate of 7%. And you have distressed debt coming. And there's going to be great opportunities.
When family officers come to me and say they want to get into real estate, a lot of people coincidentally do not have real estate experience, which is the worst possible thing. They want to get into something they know absolutely nothing about. So the most important thing I would say to them, do as much due diligence on your partner, your JP partner, and you're in bed with. That's the best thing you could possibly do. You'll regret it if you don't do it. And no question is stupid, because you're going to be in bed with these people for a long time. And if you do it, and you do the wrong deal with the wrong person, it's going to be a bigger headache than you can ever possibly imagine.
We're all shaking our head yes to that last comment. Yeah, it's not just bad. It's not just people who I'm not going to be happy working with, but real estate is filled with fraudsters. And like stories just get bad and go worse. Anyway, from my perspective, you're going to be out there. You may have real estate. You may be getting into real estate. Some investments don't work out. Some partners don't work out. When those things happen, whether you made a good decision and the market changed, or you made a bad decision and just people make bad decisions, whatever it is, I'm always available to brainstorm and try to find a solution. So thank you.
Great. Well, Harold, Paul, Doug, and Nick, thank you so much for a great panel. And Marty, thank you for having us.